Hey Dad, I found a house near the hood I want to renovate. What is the best way to finance it?
How much is the property?
90,000.
How much are the renovations?
40,000.
So you're all in for 130,000. What's the property going to be worth when you get done?
245,000.
We know that the bank will loan us 75% of the 245. What's 75% of 245?
183,000.
The bank will loan you 80% of acquisition. How much is acquisition?
90,000.
20% of that is 18,000. Plus you're going to have another 6,000 in closing costs. So you're going to need about $25,000. You can use my 0% credit cards to close on that property, okay? You can liquidate that 25 grand off, come up with the money for the down payment, and then the bank will give you 100% of the renovation cost. How much will renovation cost again?
40,000.
So you only need to use my credit cards to close on this deal, man. That is called a fix and flip loan. Very first loan you want to do is fix and flip loan. And then once you get it stabilized, rent it out, we're going to take you and do what's called a DSCR loan, debt service coverage ratio. And Caden, you already did 2 of these loans. You don't have any tax returns, any income. Did they even ask you for tax returns?
No.
Why?
They're not looking at you personally. They're looking, can this property service the debt? And if so, you're good.
Do you understand what debt service coverage ratio means?
After your insurance and taxes, it's what your ratio is between your net operating income and what your debt service is.
You're absolutely right. So in other words, whatever your rental income is has to be equal to your principal, interest, taxes, and insurance. Now, I like to make sure that we have at least a 1.2, 1.25 debt service coverage ratio, so you got some cash flow coming in. You can get a better rate doing that too. Got to be careful doing them 1.0s because do too many of them, you're going to be losing money.
Wow. Okay. So I've been watching this stuff for close to 30 years. These people that do the fix and flip, it's super easy. Use credit cards, 0% credit cards. It's 0% for a certain period of time with a substantial likelihood that you're going to violate it. It's like 80% when you do these 0% interest for the first 12 months. And that is because flipping, by its very nature, is very risky. And why do I say that? Because I've lived through the market cycles. And when I see these folks get up there and tell people, buy a property with a credit card and go to the bank and get a loan on its after repair value. I've been there, I got that t-shirt, right? At the end of the day, what the bank is ultimately going to look at is what is the rental income. In fact, there's a graph I want to share with you, and I want to show it. Boom. All right, take a look at that graph. And this represents the ratio of the price of a home versus what it will rent for. And you can see that we're in a major peak right now where we're really doing battle with 2006, 7, 8. And we all know what happened there is the prices of the homes were so high that when you liquidated them for their rental value, which is what ends up happening, when a house will not sell for its comps, it's going to find a home with an investor who is going to buy it off of its cap rate. They're going to say, I want a return on my investment, and eventually they'll get there. So $1 million houses, and everybody says, I got $1 million house. Well, okay, if everybody in your neighborhood had to sell their $1 million house, who's going to come in and buy it, right? We're going to have a comp issue, which is what happened during that period of time. And the houses were underwater, so people weren't able to really weather the storm, so they ended up being forced to sell. And we ended up with a lot of inventory hitting the marketplace all at the same time, which means investors swoop in and say, I will buy it, but the price of your house to an investor might be $300,000. It's not $1 million. And that's the rental value. When you start looking at the cap rate, what is its net operating income divided by that cap rate, it's going to give you the fair market value. That's all they're doing. And so when we go back to these gentlemen who are talking about doing this flip, and he's using this 1.25, it's not enough, in my opinion. You have to look at the rents and say, you're probably going to take in, when you add in your insurance, the property taxes, repairs, property management, all of the expenses that go along with that. It's going to be some in CapEx, which is, again, you're always going to have to put money aside to keep the property in repair, fix the roof, new air conditioners, whatever. You're probably about 50%. Some of you guys are going to scream at me and say, no, it's 60 or 70, whatever it is. I'm going to be the most conservative because I don't want to lose my katush, right? I want to make sure that I am in a position where I can be successful over a long period of time. That's not 1.25. That is 2, right? Is I am looking at it saying how much rental income, the after repair value, we don't know what that really is because it's going to be forced down. If I am judging this on comps, which is what are similar houses going for in the area within, might be a mile, might be 2 miles, whatever they're doing for their comps, or it may be just that neighborhood. They're saying, here's what the average price per square foot is. This is what your house is worth. And that's what a realtor typically does. An investor does the opposite. And they say, based off of the cap rate in the area, what is the value of that home based off of what I could rent it for? And it's going to be a very different number. And again, I showed you that chart on the differing. We are in a position right now where the prices are really high compared to the rents. So I wouldn't be looking at the after repair value other than saying, all right, if I can sell it based off of these comps, this is what it's worth. But I would also be looking at it saying, what is the rental value? What would an investor pay for this? And that might be closer to the $130,000 that you're looking at. And this is what happens all the time. Somebody flips a house, they think they're going to sell it for something, but they can't. And then they end up renting it. And now they have this debt. And he's right with the DSCR loans that they will loan you money based off of the debt service, and they will based off of the cash flow. So you need to know that cash flow before you go into that type of deal. Because what ends up happening, and I've seen this so many times, is somebody goes in, they buy the $100,000 property, they're going to put $75,000 in, it ends up being $100,000, and they were told that the after repair value is $300,000, and then somebody offers them $150,000 for it, right? The market shifts. Just for all you guys that lived through the recession, you know what I'm talking about. There was tons of flippers that got caught in these unfortunate circumstances where they were buying properties and putting money into them, thinking that they were going to be worth this high level, and then they weren't. And they could not service the debt. The interest rates were too high. We're living through some of that now. And the rents did not justify the price that they were asking. So I would add into this equation a couple of things. Number one, I hate debt. I would want you to be in a position where you could pay off that debt no matter what. If you're borrowing it, you could pay it off. I know some of you guys are like, but then I couldn't do this. Okay, but go in with your eyes open. I would prefer that you do these things with cash if you can. If you can't, I'm not certain. I'm looking at that 0% credit cards. Those things scare the pants off me just because I know the stats are that most people don't pay them off in time, and you're going to end up at 18% interest or some really high interest. Go out and find a lender that will loan you something at a more reasonable rate. Calculate your numbers based off of that. Do not calculate on an assumption, I'm going to get the DSCR loan. Because if it doesn't rent for enough, if you can't find a tenant, if whatever the market shifts and you're in a position where you can't cash yourself out, you don't want that to be the thing that blows you up. So you have to look at it saying, here's one option. I go down this path and I'll be very successful here. But if I don't get that, here's option number 2. Here's my fallback. And it should not be a credit card. Please don't do that. It should be something else. Maybe it's cash. Maybe it's a line of credit against another property. Maybe it's something else that you have access to where you say, hey, I do that 0% because I want to use this and it's at 0%. But if I need to, I have 7% money. Maybe I even have a home equity line of credit that I can tap into. Maybe I have a security back line of credit. Maybe I even have a universal life or a whole life policy that's got access to some of that cash value that I could borrow against. Maybe I have a 401k that I could borrow against. You're looking around for things where I might have money so that I don't get stuck in a situation where I'm paying 18% interest on credit. Those are my comments. And so the way I would look at it, and I would use these as rule of thumbs, if you are flipping a house, you need to be able to buy the house and complete the flip for 60% of its after repair value. That after repair value, you need to do a second calculation of what is its investor value. What if I had to liquidate it to another investor? What is its price? What will the rents be in a reasonable amount of rent, and what are the vacancy rates, and look at my contingencies. If I'm renting it for that amount, like if I can come up with that rental rate, cut it in half and say that's actually my cash flow. I need to be able to support my debt on that. And if you use those types of numbers, you'll keep yourself out of walking into huge issues that can wipe you out as a flipper. Again, have so many clients that have gone down this path. I've been watching it for 3 decades, and there's people that are and I've done a ton. I'll just be full disclosure. I have several hundred properties, and I'm not talking about doors. I don't do I'm a 2% investor in 1,000 unit. So therefore, I have 1,000 doors. No, I have individual units, including commercial properties, apartment complexes, mobile homes, single family, warehouse space. I have over 300 units that I invest with a partner, and those are our units. When you do that, you learn a few things, which is whatever bad things can happen, sometimes happen, and you need to be able to plan for those contingencies. You do that, then you're going to be much more successful than those folks that are running out there chasing the millions, thinking they're going to be really rich on flipping houses. Look, I back tested over 500 flips that either I was involved with or people that we invest with were involved with or clients were involved with, and it was about a 15% average gain on it. It's not huge. The much more successful people tend to buy, rehab, rent, refinance, repeat, right? They're going to, the BRRR on his shirt actually speaks to me, which is you're buying these properties at a discount because you're willing to put a little money in them and fix them up, and then you're keeping that property. You're just renting it out and you never sell it. Your holding period is forever. And that's the mentality that if you have that, you're going to have great long-term wealth. If your mentality is, I'm only going to hold it for 90 days and I'll be out of it, you may get stuck holding it for a year, 2 years. You may not be able to find a buyer for it. Can you survive under those circumstances? If the answer is yes, then go ahead and do it. If the answer is no, then you got to have a safety valve where you can get out of that property. You got to have a fallback position. Otherwise, you are taking on some pretty serious risk. And I've seen people go into bankruptcies as a result of these. You don't want to have that happen to you when you're trying to build your wealth. There is not a reason for you to do that. There are ways to isolate that liability. There's a way to mitigate that risk. And the way to do it is not to sit there and follow really quick advice of guys. He's just showing you how smart he is. You could do this, you could do this, you could do this. It doesn't work that easy in real life. If it did, everybody would be out there flipping houses and making millions of dollars. There are people that are very good at it, but there's also a lot of people that get wiped out as a result, and it's usually because they don't have contingency plans. That contingency plan is focus on its value to an investor. And I don't care what type of investor you are. Even if you're buying a home, you should still do that calculation to say, if I can no longer afford this house, circumstances change, I get sick, I have a bad accident, I go through a divorce, whatever it is, how much is this house worth to an investor? I need to know the cap rate. You could talk to any commercial insurance or real estate agent in the area and say, I need to know what this would be worth to an investor, and you could do a very simple calculation and get there, and that'll tell you, this is my worst case scenario. The market is crashing. Nobody wants to buy it. What will Wall Street pay? What will some investor who's buying hundreds of houses pay? We all did it. We're all there. And we know exactly, you guys who are investing along with us know exactly what I'm talking about. Is there was a price, even in the market where there was 12 months of inventory sitting around. And right now we're sitting at about 4 months of inventory. Typical is about 6 months. When you get above that, you are in a strong buyer's market and you are in peril. So we want to make sure that we do not end up in a situation where we're buying homes thinking that we're going to sell them and we don't have a marketplace on comps. We want to make sure that we don't end up in a situation where we buy a house and we have to rent it and there's not a marketplace for rentals. Right? You got to make sure that you know exactly what your market is before you make that investment. And if you like this type of advice, like and subscribe. What type of investing do you do? And do you agree with me or do you agree with the video? Let me know down below in the comments, and I'll see you guys later.